This is a local banks and CPAY session. My name's Kim Johnston. I work with the Wisconsin program, Las Vegas, and Illinois. We started our program in Wisconsin not knowing that we'd have national lenders, regional lenders that came to join us at a later date. But we started at the very beginning educating local lenders because we thought that may be the only group that we had involved in the program. Lo and behold, that was not exactly what happened, but local lenders did play an important part of our program. With me, we also have Ryan Bertram from Huntington National Bank, Dan Moyer from Stockholm Bank in Montana, and Aaron McAvee from NOPEC. I'm going to hand it over, first of all, to Ryan, and you can explain how you got into PACE with local lending.
Thank you. I was brought on to Huntington in April of 2023 to help assist and develop the implementation of the CPACE program. Huntington, for a while, wanted to enter the CPACE market, but their vision was, too big. So when I was brought on, I wanted to simplify it. You have to sell it within the bank because it takes time and patience and a lot of educating. So over that time, I really looked at like this retrofit market of project sizes from 800,000 to 10 million. I noticed that it was an underserved market. And also, we have at Huntington, we have renewable energy group. We have our public capital that does energy efficiency. So we have the ability to leverage those other sections of the bank. And also, we wanted to invest into our customers. It's just another, financing tool for our bankers to use to, sell this to their customers. We also will bring on new customers that are not with Huntington, with the hopes of that they'll bring their business over to Huntington. And so, you know, also part of the process of that was, that educating. It took about a year and a half to get it just up and running. We did our first project March of 2024, 2025, sorry. And that was a senior living facility, roughly around 1.9 million, and it was in Ohio. And that was our pilot project. That's how we sold it within the bank. Let's run the traps and figure out, how we can get this better. And so that's what we did. We did run some, little things here and there. The Bricker team was great, helping us out, with our internal legal, with our operations, so that was a big help. And then we closed our second one in September of 2025. That was also a senior living facility. And then we went back for approval to do full launch now instead of, okay, we're out of the pilot stage. Now we're going to move forward with additional states. So now we're not just in Ohio, we are going to enter Michigan, we're going to enter Illinois, enter Wisconsin, Minnesota, we're in Colorado, we're in Texas, trying to enter to North Carolina and the Pennsylvania. So that's like now our approach. We're full blown and moving forward. And like I said, retrofit only. We're staying away from the new construction as we saw that there's more of a risk. And so that's why we're just going to maintain this retrofit project.
I'm Dan Moyer. I'm with Stockton Bank in Montana. I'd say we're at a slightly earlier stage than what Ryan's at. We are the largest Montana-only bank. Our assets are a little under 10 billion. So as we were kind of dipping our toe into the CPACE world, I think what really drove that conversation for us internally was we didn't want to see, sorry, PACE Equity and everyone, all the other capital providers, we didn't want to see some of the larger players coming into our market and reducing our commercial real estate lending footprint. We had a lot of existing customers that we wanted to kind of keep in the fold. And we saw the CPACE tool as something that there was going to be increasing interest in, a product that from the get-go we didn't necessarily have great understanding of and how it could potentially serve our customers. But we realized we needed to try and be early on this because as more and more development and projects were going to be occurring within the state, we needed to be on the front lines of that and to better serve our customers. So within the last couple of years, we realized that some of our bigger recurring customers had projects that they wanted CPACE to potentially be a part of. And so we knew that, okay, we need to dip our toe in this in some small ways so that when those bigger projects come down the pipe, we're able to perform on those, and just have a more expert opinion and be able to serve our customers. Just recently closed on our first C-PACE loan within the last couple of weeks. It's around 500,000, but seeing a fair amount of increased activity in terms of inquiries and more interest in the C-PACE product, even this year, as we've been what we've historically seen. I think Montana's only done 8 or 9 since the program was approved in 2001. So we're very, very early stages in it as a state. I think Stockman's probably going to try and stay local to Montana. We probably have some one-offs in other states, but I think our approach is going to try and be to stay local to Montana. In terms of deal size, I think we're probably going to be pretty flexible with it. It probably doesn't make a whole lot of sense for our customers to be doing really small projects. I believe the conversations I've had, if it's under 150, 125,000, it probably doesn't make economic sense to do it for the customer. But we do have the flexibility to go up. If it needs to be 60 million, we can do it. But that's probably going to be a combination of C-PACE and some other sort of debt structure.
Hi, my name's Aaron Markovi. I'm the Chief Business Development Officer for NOPPA. We are the Ohio's Public Energy Council. So we're a statewide government agency, and we're a little bit unique compared to some of the other banks here in the room, or even other PACE capital providers that are not necessarily banks, in that we are a council of governments. So we are a government agency, only we're an independent one that is made up of 250 plus community members. So they all join, and our primary business is energy aggregation. 6 or 7 years ago, our board got together and realized that PACE was really beginning to gain a lot of traction here in the Buckeye State. And they said, well, why don't we take some of our retained earnings or some of our hedge proceeds and put it into a fund? And that's where our PACE fund began, and we've really started to grow it over the last few years. We have deal sizes that are capped out at $1 million, so we're very small compared to a lot of other ones, but this is great for the small business community. That also comes with some challenges because of various, maturity levels of small businesses or family businesses. Our average deal size is about 400K, give or take, I would say, over time. But now, in the last few years, especially with inflationary pressures, they've been really trending a lot more towards that $1 million cap. And we've been finding that a lot of our applicants have been either, declined on account of the sort of nature of things, I think, in the capital market, or the deals are just a small part of a much larger, $10, $20 million thing. So that's kind of how our program got started. We're a small team, but it's been very exciting to see a lot of the growth here in Ohio, especially.
So we had a list of questions that came up yesterday, and since you all are here, can you give some of the program admins some advice on how to approach local lenders, especially to get them involved in doing loans under $1 million?
Yeah, I think, like I touched on before, I think it just comes to educating like local lenders on PACE. And it takes the time, because with, going through Huntington, there was some frustrating moments. I felt like we weren't getting anywhere, but there was always a list of questions, but we always came back with the answers. And so I think it's just the constant education and how much of a benefit it is for a property owner, right? So that's how we look at it too. This is, we're helping out the customer, and I think, like Dan, as you touch upon it, like to me, it's relationship, right? So I think that's how you sell it to a bank, is like, if you want to give a good benefit to your customer, here's an option, here's a financing pool that you can give or offer to them, and that will help. I think one of the toughest things too is we do PACE has that long term, right? And that's a hard sell within a bank, because they don't want to keep it on a balance sheet. It gets risky. They usually want to get it off by 10 years. But as we looked at it, like that, we're invested into our customer. We're okay with holding on to it. And I think if you just keep talking about investing into the customer, I think that's a huge sell.
I think to to add to that, if you can approach a bank and show yourself to be an asset to them, as here is how this can help you guys create new relationships, maintain the ones you have, and be able to show the value that the program can provide to the bank, that's going to go a long ways in actually garnering that first little bit of interest from them to make them want to go in a little bit deeper. Like I said, we aren't a tiny bank, but we aren't a huge one either. So I think you want to probably, if you're only have a few smaller banks in your portfolio in your state, you probably only need a couple more. Get 2 or 3 of a decent size that can actually handle that smaller volume is probably going to go a lot better than trying to do kind of a shotgun effect where you get a ton of small banks that maybe can have the size to only do a couple of projects and then they're at capacity. So investing in just a few of them so that going forward, hey, I can send to these 3 or 4 partnering banks that we've worked with before. They have a good understanding of the product and can work with and have that history working with you guys as administrators to know this process is going to go a lot more smoothly. It's going to be a more streamlined process. You don't have to reinvent the wheel every single time.
I would definitely echo both of these sentiments, especially about education. Whenever we work with a bank, if there's another lender, usually the small business comes to us and they say, well, here, talk to, so-and-so, they've been my banker. And usually that person is somebody that just caught the call whenever they called in the first place and said, I need a small business loan. We call those people, and in many cases we work with Bricker here, and a lot of times they help us out with it. But when we call them, they say, well, I don't want, I don't want anybody to have another mortgage in front of ours. And even though it's a semantic argument, most of the time, the people that catch the call at the desk in the bank, they have maybe never heard of PACE. So this is an opportunity to educate them. But also, and I know it's a semantic argument, you say, no, well, you're still going to have the first mortgage on the property. And oftentimes just being able to, for whatever reason, because a lot of them, especially with some larger financial institutions, are kind of doing so much volume, as soon as you assure them that they will have the first mortgage, yes, we understand that there's a tax liability here, that oftentimes is enough to be able to get into the next conversation. And then if there's another roadblock as you kind of work your way up the chain to be able to get an approval, you can explain that, well, if somebody's going to get delinquent in a mortgage, chances are they're going to be delinquent in taxes. This is handled in much the same way, at least in Ohio, that it would be other taxes. So it is a semantic argument, but just being able to understand that oftentimes a small business, especially somebody that's looking for a loan of under $1 million, they're dealing with not like the president of the bank. Maybe if it's like a real small credit union, they're up in the food chain, but oftentimes just getting past the checklist or whatever that the person who catches the call needs to check off before accelerating it to have the more in-depth conversation. We found to be very helpful.
Yeah, I just want to add something to that. I think one of the things when I was going through the process of getting approved within Huntington, was the question, why aren't other banks our size doing this? Right? That was one of the biggest questions. And when I did all my research and we had smaller banks, I looked at Key does their capital markets and that, Citi apparently from last year is entering the market. Haven't seen much of that. But, how we explained it was, well, because it's getting educated, right? It does get frustrating. And through the years, I've seen people go to other big banks and try to get PACE done or get it approved within, and within 6-8 months, they leave that bank and they go back to doing what they were doing because it takes time and the patience. And like how we were selling it is investment. We're investing into our customers, investing into the community. As Huntington's all is big about is their customer first. That is what they're big on. So that's how I was able to sell it that, hey, we need to be the first, right? Because once you're the first, I feel like other banks will start falling in line because they see that you're doing it. So
I think to build on that, it's serving the customer kind of comes first for us because we're seeing them on a day-to-day. We're living in the same communities that they are, and the improvements that they're going to be making to these properties, we're going to be driving by on our way to work. We're going to be seeing them, living in them. Our friends are going to be staying in their hotels. It's all of these kind of things where we're going to be seeing the downstream effects of these projects. And so having this tool to provide to the customer, I think is a huge asset. I want to say that if we have an understanding from our administrators that we as the capital providers are going to be ceding a lot of our traditional control in this type of product, our ability to collect on time is pretty heavily nerfed here. And so just encouraging us to do the due diligence early so that we can get comfortable with it. It's going to be a lot of upfront investment from us in terms of our time, and trying to get comfortable with the product. You're going to have to buy in at multiple levels within the organization. You're going to need our chief credit officers to sign off on this type of thing. Same with we're going to be a consenting lender on a project, which we've now done both of. But having someone you can throw at this, or a team you can throw at a project like this for a local bank is going to be huge, because you're not going to be able to tackle something that is so far outside of the norm of our typical loan structure. It's going to take time, and patience is going to be key.
One of the other questions is, what are the barriers that you see for small banks or local banks, to get involved in CPACE, and how can you help our program admins and work around objections?
Yeah, it's like what I was just saying before. One of the hurdles is the educating. It does take a long time to get it through, and you're going to get a lot of questions. And it's just the point of, like, as long as you don't hear a no, you just keep going, right? You keep going at it. And so that's kind of how my colleague Tom Rath, who's here, that was when I vent to him about the frustration of it. And he's like, hey, man, you didn't hear no, just keep digging away. And so I think, that's what it's going to be, is just the educating part. And because, like I did say, the long-term banks don't want to keep it on that long. You just got to keep reiterating it's an investment. Dan mentioned your customer. That's what you're trying to do. You want to sell to them that this is for your customer, right? It's going to benefit them, and it's going to benefit the community.
Yeah, and I touched on it earlier. It's the initial investment is really where the barrier is. We just closed on our first one a couple of weeks ago, and there were basically 0 overlapping documents with our traditional loan package. Didn't use the same promissory note. It didn't use a lot of the same language. And so there was a multi-month process where we were looking at, okay, we've got a very solid basis in what the state has created in terms of documents to make sure that we are secure, to have agreements between the property owner and the local government and ourselves. There was a lot of strength there, but there was still a lot of time that we had to spend up front to make sure that we were comfortable as an organization, that we fully understood what our rights were here, what can we do, what can't we do, and are we comfortable with that? And there's going to be a lot of banks that really can't check all those boxes, that they're not going to have the size or the volume to support the amount of upfront investment. And that's where it's going to turn into, okay, maybe they'll be the senior lender, and they will need to get comfortable with someone else who is going to be coordinating with them, who's going to be working alongside them to get these projects across the finish line. And I think as long as, and like I said, you're not going to have this huge armada of banks that are going to be willing to work with you on stuff, but it's still going to be constructive to try and educate and be a resource for even the ones that aren't going to be your capital providers, because a lot of them are still going to be consenting lenders. And so even if Bank A is only going to be the consenting lender, they need to be able to reach out to their program administrators in their state to say, wait, why should I do this? Bank B wants to be my capital provider, and why do I basically want to be in a subordination agreement to them? And do I really trust what they're saying? And having you guys as the resource that they can go to reassure them of what this actually is going to go a long ways.
I just want to add one quick thing. Yeah, I would say too is, during our process, one of the big hurdles too was legal. Like they it took them time to educate, and the Bricker team did a great job of really walking it through with them, and explaining, again, because default was a big question too. Like, how does this process work? What do we got to do? And so they did an amazing job of really walking our internal legal through. So one of the things I would say is you have good legal team, definitely get them involved because the banks are going to bring in their legal right away. That's one of the things that I.
Yeah, I love the phrase, Ryan. They didn't say no. We say that a lot around our shop too, because a lot of our deals are really sort of customized. And then to talk about the local input, at least in Ohio, if you want a PACE deal to go, you have to go get an ordinance passed or resolution passed for your city government or your local municipality. And uh, we've seen all sorts of different takes on that. Most of the time, they go off without a hitch, and it's unanimous. We have had on occasion in a county a little north of here, one of the trustees, we came in for so a three-person panel has to vote on it. The resolution's there in front of them, and they said two of them said yes, we're unequivocally yes. There's great economic development benefit here. One of them was uh, you know something, I know this guy that's going to be building this building. I know the business. I appreciate the business. I think it's a great thing, and I'm going to vote no. And we said, why? And he said, because I philosophically don't believe, this is a trustee, this is an elected official. I philosophically don't believe that the local government should be having anything having to do with a private business transaction. And then it comes again to education of the local government to be able to say, okay, fine, we understand the philosophy here, but also you're serving as a safeguard, you're serving as another set of eyes to make sure that there's nothing wrong with this, and ultimately it's going to benefit your community. And that, I think, has a ripple effect in the faith and credibility of us and the faith that another lender might have in the project. So the system in Ohio requires some of these extra steps. And once you get that kind of, perfunctory, here you go, it's almost a rubber stamp thing because it doesn't cost the city anything, and they're still enjoying the benefits of the economic development and the investment in their community. But there's an awful lot of liability as a hurdle that could have a ripple effect on the confidence of the local bank, because they would say, well, wait a minute, you're telling me that the community doesn't want this? And that's something that you also have to try to avoid. So in terms of problems or hurdles, that could be one. Normally it doesn't happen, but every once in a while somebody raises a hand on philosophical grounds that are questionable at best, but you got to deal with it.
And I have a unique question. So from a CPACE administrator perspective, how do they create and sustain a valuable relationship with their local lender once they've signed them on?
I think when we were working with Chris Jones, the Ohio program, it's about referrals. Like, how can you help us out? Like sending us deals, like especially what we're looking for. And Chris has done a great job in setting that. I said no to a couple, but I think that's how, if you can send them stuff, I think it helps them as well too. That hey, there is this more of a market, and then they can actually then start working with their current customer base, and that's how I think.
Yeah, I agree. The referral network, currently most of the people I'm talking with for CPACE are coming from through um, our state team. And I think just making yourselves available, I mean, pick up the phone is such an asset, and it's such it's so many points in your guys' favor. If we have a question and we know, hey, maybe you don't pick up, but within 10 minutes you're calling me back, that's huge. Obviously, as deal volume increases and the amount of busyness going on ticks up, that's not always going to be possible. And we understand that, but at the same time, especially early on in the relationship, making yourselves incredibly available, make yourselves the experts, and have the answers that we know you guys know it, and that's why we're reaching out to you and just making sure that you're patient with us, because like they were saying earlier, we're going to ask the same question over and over again because either we forget it or we thought it was, it only pertained to this one aspect of it. But no, there has more broader implications. So it's the same answer. So just patience with us, keeping the kind of the deal volume flowing, and showing us what the value in the program really is.
And we're in sort of a strange position because in Ohio it's sort of a pseudo administrator thing, and we're both lender and we walk the businesses through it. But the only thought that I can give, especially as it relates to our healthy relationships with other lenders that are on projects who we necessarily need because PACE can't cover everything. So you want to make sure that they're involved so that your project actually is viable and revenue producing to deal with your debt service, move it along. The big thing that we've found is over communicating with the borrower and just make sure that they make their payments. And by over communicating, even if we had to have a big internal discussion about a year and a half ago where we said, look, what business is it of ours? They should be running their business the way that they signed the documents to. And that's naive. We immediately pivoted to, we're going to text these people. We require that we have a cell phone number of the principal of the business and whoever's going to write the check. We text these people, we send them an email, we send them written letters. I would resort to skywriting if I thought it would be effective. But we've out of the history of our program, we've only had one default. I'd say knocking on wood, and hopefully it'll be resolved actually in the next couple of weeks, at least to come current. But we found that even though we're filling in for a tax collector, that what the county does, and I love the counties that we work with, they're just kind of doing what the statute requires them to do. We as these administrators or even lenders have the ability to over communicate with that and really stress right from the point of underwriting, which was discussed in the last session, all the way through to the actual, until the repayment becomes habitual, making sure that they know, like, no, don't screw around, prioritize this. Even if you're in that construction phase that is going to last a little longer, or your shipments or whatever were delayed for your construction, look, this is going to be a problem unless you prioritize this. So that over communication through every mode possible, including stopping in. Also, and we've taken to doing that because we make rounds to other communities that are members of ours. So once the ribbon is cut on the building, we'll stop in and say, hey, remember us? We made your business possible. Great. You got 5 more months before this is coming, just as a reminder. Not trying to be a jerk, but like you need to know that this is coming so that there's no extra penalties, fees that are going to cause this cascading problem.
Yeah, and one thing I would like to just add to, like when I was talking about this pilot project and referral, because we do internal training as well with all our other bankers on the product so they can go sell it. But we were looking for the pilot project, and at the time we still weren't getting much traction internally like we are now. And I remember I bugged Chris like, we need a deal, like we need something. We got to show the proof of concept. Just send me something. And that's how we did our first deal because it was referred to from Chris, and that's I think the referral is a big part of it as well.
And this is the last question they had. Is there any specific market sector that you think would work well with local banks, whether it be hospitality, small business, small industrial?
Yeah, I think for us, it's really in like owner occupied industrial facilities. We like senior living facilities. You know, um, you know, Again, we stay away from the new construction aspect. So we're not really looking into hospitality. But I think it depends on the bank. It depends on what their credit appetite is, right? So like for us at Huntington, we do have a very low to moderate risk. So that it does make it a little tighter on projects. So I think it just depends on their credit appetite of what they can handle.
Yeah, I think we certainly try to be a full service bank. There isn't a particular asset class that's off the table for us. We don't do a lot of the industrial stuff, but I think we have an appetite for it. Um, and I think a lot of the stuff that we're looking at least in the market where I am in Bozeman, there's a lot of multifamily growth. There's a lot of hotel growth. Um, we're seeing ways in which even larger condo projects can actually be on the table for CPACE that might make it a little bit more underwritable. So there's some exciting stuff we can look at there. But I think it probably makes the least sense for us on the small business side. There's a lot of times where, um, at least at this point, and maybe as the program continues to evolve, there will be a shift in that. But at this point, it does seem like we would rather, why not just do it as a traditional senior loan or a second behind ourselves or something of that nature? Why use the CPACE program? And so I think as we continue to evolve and see kind of the benefits of the program, we may shift on that. But I think it tends to be the retroactive pace where, hey, maybe we do a construction loan to complete the project and finance it with CPACE. So actually, I might be kind of curious to hear from you guys. What are some ways in which we can augment our current practices? When does it make more sense to do CPACE from the get-go, and when does it make more sense to use it as more of a retroactive refinance?
In answer to the question, I would say that our portfolio is pretty diversified. There's we're a government agency, so there are certain industries that we probably hold up to uh, not different standards, but I think more thematic scrutiny. Things of the vice industry nature, for instance. That would carry with it certain political issues. But other than that, we really do try to make sure that it's a diverse portfolio. A lot of banks that are senior lenders are very happy about it because as a government agency, we're very, very risk averse, and our underwriting standards oftentimes are actually stricter than some of the financial institutions that would otherwise work with us. So that by its nature works out. But generally at this point, we're always in favor of, the longevity of a business, especially if it's heavy industrial or light manufacturing. The state of Ohio has a lot of tax credits, TMUD incentives, stuff like that. So, the owner occupied 70% of a mixed use facility. That's kind of our sweet spot because oftentimes PACE can fill in for the last mile of their construction project.
You asked the question, when do you decide? I don't think I've ever thought about it that way. I think when we work with people, we try to get them to, get interested in PACE and do PACE. If it doesn't work out for some reason, it's not infrequent that they'll come back and decide to do retroactive. But I can't imagine telling someone don't do PACE now because later you can do it retroactively, although people on their own decide that because they think the interest rate's going to go down.
But just more from the bank's perspective, why would they want to basically complicate an already complicated process, which is construction, by adding in this particular type of financing on top of it, where you're going to be advancing the full thing and you're going to have interest only costs, etc.
I mean, the main reason is that the payments are lower for the borrower because it's spread out over a longer period of time, so it makes it more doable for them.
If I can, in the back here, the other reason you would do it is maybe it's the payment part, but retroactively, you can't count the savings that it's already been used, right? So if you wait 2 years, 2 years of eligibility of whatever product you installed. So that means the term can't be as long, at least within our program. I can't speak for every state, but in general, that's how that works. So the idea is if you do it once it's installed, then you've got the full usage available to you to count as a useful life.
That's true for us. It takes away a couple years, right?
Hi, Ryan, you mentioned earlier that you have an appetite to hold the paper long-term in the spirit of supporting your customer and, being a good asset to your customer. I know that banks, FDIC regulated institutions have a lot of sensitivity for the long-term aspects of CPACE. Have either of you, as the bankers on the panel, have you guys explored various exit strategies, securitization, moving the assets off to other people that are doing securitizations or selling them off individually to the life cos, insurance cos, some things like that?
Yes, yeah, we definitely explored it. That was part of the process of the approval. Of like, hey, if it does go south, what are our options? What's the exit? So we have explored selling the paper. We talked to a couple other like non-bank providers that will set up like a relationship if that time comes that we have it set up, that who would have an appetite for it if we have to we have to sell it off, or because selling off would probably be the exit we would go with.
At this point, we're not considering selling them. We're trying to keep them on balance sheet. As we continue to grow, that may change, and so we're trying to put more scalable practices in place so that they can be securitized at some point if we do want to go down that road. But at this point, we're not looking to do that. We're kind of acknowledging the risk of we should be able to collect on these, but there is going to be that timing risk rather than the collection risk.
I can also tell you that we hold the paper too. Generally, we have recapitalized once through a port authority that these assets were included in a bond sale. Um, it was very complex and excruciatingly painful. So I'm not sure that I would automatically recommend it, but the municipal bond market, does potentially serve as a source for recap.
Hi. So tell me if I'm wrong about this, but Ryan and Dan, it sounds like you both were kind of champions within your institutions to move CPACE to become CPACE lenders. And do you think that that's kind of the typical, like, do we need to, and in the Philadelphia region, do I need to find the Dan and the Ryan in our local banks to say, hey, this is great, and I really want to push my bank to do this? Or like, what's your take on that?
I mean, in my experience, it was our state representative, our administrator, going to our chief credit officer, creating a good relationship with him, and him saying, okay, we need someone to run at this, and finding someone who has the capacity to really get into the weeds on something, to be goal-oriented, and to have the agency to, okay, we need to protect the bank here. We need to serve our customer. Who can we put on something like this who has a little bit of time to dedicate over a long period of time, some access capacity from that, where that person isn't going to be reaching out every week. Hey, what about this? What about this? There's going to be an understanding that the person needs to be able to problem solve. So if you already have a contact within that bank, maybe the conversation needs to be, who can you think of right now? Who's top of mind? Who checks all these boxes where you can trust them to not go too far down the path without checking in with you, but they can go at least yay far to make sure that it's actually them who's driving the process and not having it to be something that's a fire that the chief credit officer or whoever they is constantly having to tend.
Yeah, I completely agree with that. Like, so for me, I entered the industry in 2018, started at Lord Cap Green as a transaction manager, then went over to Y Green as a senior commercial underwriter. We all know what happened to Y Green. So, got laid off, and there was that in between. And for me was, I interviewed with other providers and nothing really, I ended up getting really good bites. But then with Huntington, I saw a renewable energy sales position. I am not a salesperson, right? I am operations, I'm behind the scenes. And so Tom and our old boss, Jeff Elliott, had this huge interest in CPACE, right? And so when he saw that was on my resume, that's how he asked me, how would you do this within a bank? And it's kind of luck, if you want to say it, that I got onto it. So, I think like what Dan said, if you find that person, like how Jeff had, trusted us with this project, knowing that we can keep running it, we'll touch base every once in a while, we educate everyone. I think you find that person who, is driven and is going to, take the time and go through it.
Yeah, someone who's going to have the thoughtfulness of what are the downstream implications of us doing this. In Montana, we have it's an on-bill state, and we have the November payment and the May payment. So there are going to be all sorts of externalities of that, and each county is going to be different in their collection processes. Sometimes that end of November or end of May payment's going to fall on a weekend. It's going to get kicked. It's going to kick the payment if the county doesn't process that payment in a timely fashion. So setting up our processes early on to show, okay, we are not going to be showing this thing as 30 days past due every single year, just for balance sheet management and for reporting. You wanted to try to avoid that because a $500,000 one, that's not a big deal. But over time, these things are supposed to be long-term assets for us. They're sitting on our balance sheet, and we have 40 to 60 million. That's 30 days past due every single year. that becomes a problem. And so creating those systems early on to help mitigate some of the things. And so having someone who can get into the details of this and try and set up an organization for success really early is going to go a long ways to creating the right kind of program within a bank.
I touched upon what you said exactly. I think the process, right? That was a big part of it too. Like, hey, did you talk to like accounting on this? Did you talk to our closing team? Did you talk to legal? You know, so we developed this process, but also we try to mimic the process. Like I mentioned earlier, we have the renewable energy group. We have our public capital, those energy efficiency. So how do we kind of mirror without recreating the wheel, right? We basically mirrored those two like processes into our own, and so we didn't like create confusion with trying to develop a whole new process because we definitely knew that if we did that, we would definitely get a no, and then I wouldn't be here. So
The common pushback I've gotten from both local all the way up to national banks I've talked to is know your customer requirements. That the fact that the assessment automatically transfers in a sale and you have no control over who your borrower might be. Was that something that came up in your internal process? And if so, how'd you get around it?
yes, that did. So with what we do in Ohio, and when we were going through our legal docs, so we again, with Bricker really helped us out with internal, and we kind of had to like we took those templated documents. Legal didn't like certain things, so they were able to tweak it and allow it. Now the know your customer part, that was a big part, and we do have in our Ohio docs that we have a right to refuse the new owner, right? So we have that obligation. Bricker advised that it's okay you have that, but it could be a huge turnoff because that's one of the big selling points of PACE is that it can transfer to a new owner. Then you can walk away. So we have in our Ohio docs that we have the right to know who's taking that property, and that's what we're going to try to mimic across. Like we just are entering the other states, we're going to try to mimic across. And we talked with Colorado about it, and they're willing to put that for us as the language. And then I got talk to Texas about if that's doable.
So what does that look like? Are you stepping in and underwriting?
Basically, so yeah,
Yeah.
basically doing a whole re-underwrite, the whole thing.
Yeah.
Yep.
We had a similar concern, exactly. What if this asset transferred to someone who wants to turn into, like you were saying, where Vice could come in? Do we trust this new owner? So we definitely pushed a little bit to try and get that language put in, that we basically do have that right of refusal, and that it wouldn't be unreasonably withheld. So we left it pretty open. Obviously, we've just done the program, and so we'll actually see how does this actually play out if our current owners look to sell. But it was definitely something that was on our radar because obviously it's supposed to be non-recourse, and you're looking very heavily at the asset and its ability to perform. But obviously, at the end of the day, you are lending to people, and those people are going to have varying degrees of strength in their ability to manage an asset and actually have it produce like the potential that they're doing.
So ultimately, you got around it by you have the ability to stop a sale.
Yes.
Need be. Okay.
Or at least call the note basically at sale.
Oh, you could accelerate.
I think with what we were doing, we do have we did steal from our own normal loan documents the wording a fair amount of that we can basically call the note as part of it, or it would be a condition of default, and we gave ourselves the ability to kick in an extra 5% on top of. So even though there may not be the ability to really call the full note necessarily, if that were to become a full-out drag-out legal battle, but we were able to call it a condition of default to basically incentivize, like, you don't want an extra 5% on top of whatever this is. It would basically be assumed by the new owner, So we probably cannot actually prevent the sale itself. And so the new owner would assume that debt as part of the property transfer. But if we theoretically did not provide our assent to that transfer, it would be considered a condition of the default. We could implement that higher interest rate.
We've been dealing with this issue since the one default that we had as well. Because to everyone's point, you don't have that control over the new owner. So again, working with Bricker, we're exploring the possibility of a triggerable assessment that would be a balloon payment in the event of undesirable transfer, which would effectively call the note vis-a-vis the tax structure rather than an independent promissory note or independent agreement. We're not 100% sure that it's going to work and how it would be structured. But the idea of a balloon payment in the event of a sale that you wouldn't necessarily be able to stop, but you could then at least have a recourse to call in the note if the new owner were, a developer that was, or if the economy really were to make such a horrendous dive that a sale would not actually, be able to support it from a revenue standpoint. So we're looking at that as well.
For this language that you guys have found a way to put into your C-PACE loans, where you get to re-underwrite if there's a future sale of the property, that obviously reduces your risk. Do you have a feel for how you would price that risk reduction and where you would like to see your C-PACE offering relative to other C-PACE paper that doesn't have that risk reduction? You have like a feel for how you price that?
That's a good question. I'm gonna keep that in mind and look into it.
Yeah, I'm not sure if we've
yeah.
done enough of this yet to even start to empirically get our arms around it.
Yeah, I don't think we've necessarily settled on how we want to price it as a whole at this point. Obviously, because of how the payments are structured, we tend to make a little bit more interest on it just because you're not paying principal monthly on it with the on-billing.
Right.
I think there's certainly an opportunity for us to, as a competitive advantage for ourselves, since we are keeping it on balance sheet,
Exactly.
that we could try to have a little bit lower interest rate there, or potentially we'll look to price it based on if a 5-year treasury were here and we structured this in our traditional 20-year amortization or whatever, how much would we stand to make over X number of years, and then kind of back engineer from that. That might be something we look to do.
Right.
But I don't really foresee us wanting to really get too into the nitty gritty on the fact that we have the ability to relook at this note down the road. We're not probably going to do the full underwriting ourselves. We're going to look at the historical performance, and that's going to be great. But it's not something where it's going to cue a full new underwriting for us. So I think it's going to be more of, okay, what's the intent of this new purchaser of this property? Are they basically going to be doing the same things? Fantastic. It's not a big roadblock. We are certainly not trying to trip up our property owners and make this all of a sudden an asset they can't sell. We just want to have that ability. If we have a real concern about something in good faith, then we wanted to give ourselves some rights there to either hold up the transfer a little bit, make it a little less palatable for the new owner, or they choose to pay it off or whatever that is. But we wanted to try and protect the bank a little bit, just in terms of, because it's not enforcement, it is basically assumable by a new bank, by a new entity, by new bank. That we wanted to make sure that we had a little bit of more control than what the kind of the default language of the document was providing.
Okay, perfect. Thank you.
Thank you for having us.